Welcome to another episode of Not Investment Advice. We've got the NIA boys here. Me, Master Flex himself, Trung Phan, and we have Jack Butcher, founder of Visualize Value. I don't know why I just paused there. I was going to say your full Twitter handle for some reason. I was going to say Trung T Phan, but we've got Trung Phan and we've got Jack Butcher, founder of Visualize Value. And as always, I'm Bilal Zaidi as well. Boys, we've got a packed agenda today. We've got some killer topics, but we're always going to start off with meme of the week. And Trung is going to be our meme master today. So over to you, boys. Meme god.
Okay, so for the record, I don't want people saying, oh, Trung's always memeing himself. This is not me memeing myself. This is our old friend Alex Cohen. He's roasted me yesterday on Twitter. So for the listeners, not the viewers here, your boy Trung Phan created a cohort course with Maven. The cohort course startup, which full disclosure, Jack Butcher is an investor in. Jack, is this correct?
That's correct.
That's the pump bag segment coming later.
All right, so people, we have something called the bag pump of the week that we're introducing this week. We're just going to combine it with meme of the week. So I made the announcement yesterday on Twitter. I wrote, I get asked all the time about how to research, write, and publish my ideas. So I created this course with Maven. It's called, I think the name is pretty glorious. It's the Better Business Writing Bureau. The plan is that I want the Better Business Bureau to actually sue me and tell me to not use their name, and then they'll create the buzz. But I'm such small potatoes that it probably won't even happen. But our friend Alex Cohen quote tweeted my tweet and goes, "We've lost a fellow ship poster to the course selling mafia." And here's where it's hilarious. How many likes does he have here?
I think that's called a ratio. I think that's what the kids call it.
He had 873 likes on his quote tweet, and I had 259 likes on my tweet. Oh my goodness.
Now you know how Parag Agrawal feels.
Yeah. So yeah, Parag's getting roasted by Elon on his Twitter bot thing. We're not going to talk about it today. We've over talked about Elon. But the last thing I'll say, because it is we're combining bag pump of the week, is go to maven.com/trung/BBWB if you guys want to stick it to Alex Cohen.
We'll link it in the show notes, mate. All good. Yeah. So I was gonna say the reason it was funny for me as well, because I saw it because I'm in London. I saw it a few hours later, and someone had clipped the conversation us three had when Jack was out, and Alex Cohen was making jokes about people doing courses, and it was like a 1-minute clip. It's pretty good.
Well, I can paraphrase it. I asked him directly. He's like, "What's wrong with people that do these threads?" He's like, "Well, I'm a shit poster and I do it from a place of authenticity," which I agree with. He does. So do I. But he goes, a lot of people are doing it just to grow the audience, just to eventually shill a effing course, is what he said.
Jack, how'd you feel? You sold a few courses in your time, mate.
Yeah, I think there's an obvious amount of turd in that market just because of the barrier. The barrier to entry is very low, right? With everything else, this is like the last cycle's shitcoin behavior. It's like if anyone can make it, you better believe 90% of the stuff is going to zero and is a waste of your time and money.
But not these two on the call right here. I mean, I haven't taken Trung's one, but I've taken Jack's, and I know Trung enough to know it will be a banger, I'm sure. All right, Trung, we're going to need an update in a few weeks. Go on.
Sorry to interrupt you, but I was going to say, I think it is an unfortunate connotation because someone like Trung has an obviously very strong skill set and people could learn a lot from him, and to be bundled in with people who are not doing that have the background, or there's if you compare that to another institution that you would have to pay to get that knowledge, mainstream institution, you're talking about a 10, 20, 30, 40x investment over a lot longer period of time. So not all education is bad. That's what I would say. And I think it's a dangerous, slippery slope to just imagine that everybody that's trying to build an education business is trying to rip people off. That's not accurate.
Yeah, of course. Also, let me add. Go on,
sorry, but I want to add one point to Jack's thing. Is that is so true though, because there's that gut feeling of doing it, right? I mean, Jack, you've been doing it so long, you have such a well-established reputation. But if I'm being fully frank, is that was mentally the biggest hurdles because it's like if I launch an NFT project, everybody would just think this guy is trying to grab a bag, right? And it's gonna go as such announcement.
No, I'm joking. I'm joking.
Well, here's the reality. I probably wouldn't be able to get it off the ground because, maybe a year and a half ago. But, dude, yeah, I agree fully with that statement. It's such a broad brush. And listen, I overpaid to this multiples you said 30, 40 times for not good education, right? Like, straight up. Like, I have a master's degree. Not worth it.
And a CFA. Yeah.
Wow, that rolls us perfectly into the next topic.
Yeah, exactly. Well, I will bring a bonus. Well, first of all, check out Trunk's course if you're interested. Secondly, I'm going to pull up a bonus meme of the week. Let me bring this up here. This was the conversation around the New York Times post. So I'm going to pull up a tweet here. Can you guys see that?
Yeah. Oh, man. Derek goes so hard, dude.
So if people haven't been following this, let me get those DMs out of there. So we've got, should we just read out the passage real quick? I mean,
yeah, read the one that read the first paragraph.
What he said?
Sentence.
Oh, okay.
No,
what New York Times? Yeah. So there we go. So there was the background really quickly is there was a post, there was an article in New York Times written by, I think, a PhD in economics.
From Harvard.
Yeah. And there was a bunch of stuff in there. He was so surprised about how people become wealthy, essentially. And the study didn't tell us about the small number of well-known tech and shopping billionaires, but instead about the more than 140,000 Americans who earn more than 1.58 million per year. The researchers found that the typical rich American is, in their words, the owner of a regional business such as an auto dealer or a beverage distributor. And then the next one is, he says, this shocked me. Over the past 4 years, in the course of doing research for a book about how insights buried in big data sets can help people make decisions, I read thousands of academic studies. Anyway, he goes on to say...
No, wait, hold on. He goes, it is rare I read a sentence that changes how I view the world.
That was the one, exactly. So that was kind of meme of the week. And then the guy Dave over here basically said the New York Times really published an article where the author was stunned that the typical rich person is someone who owns a business, not someone who earns a paycheck. This is like an ad for how disconnected their takes are from common sense or reality. So obviously, this isn't a meme with, text and images, but we've talked about memes a lot on the show. And this is as much of a meme as anything else. So yeah, boys, I think one of you shared it. Maybe Jack shared it in the group chat. Or maybe I feel like we all shared it at different times because we saw it and we were like, what the hell is going on here? So Jack, tell us about your take on this, because you're obviously a business owner and you've gone through, many phases of this kind of development. You might even have hit that level they were talking about. I'm not sure the exact numbers.
Imagine if that PhD economist from Harvard found out how Jack bought his house.
So he sold 3 bored apes and... so go.
Bilal, get the screen share again, because the last paragraph is the best
All
part.
All right, let's pull this up here. The last paragraph
says...
Oh, here we go. Yeah.
What are the lessons from the data on rich earners? First, rich people own. Among members of the top 0.1%, the researchers found about 3 times as many make the majority of their income from owning a business as from being paid a wage. Salaries don't make people rich nearly as often as equity does. And that was when I read that sentence, it's like, how can you write that? Like, how can... What is your concept of what a salary is or where it comes from?
Yeah.
You know what I mean? Like, so your assumption is that there is this, there are businesses that pay out more salaries than they do increase in value. It's like, that just doesn't make there's no logical universe where you can make sense of that statement. So then the caption written to a company on Twitter was perfect. It was like, this is just an ad for how disconnected. And I don't think, you could say it's like the New York Times, but it's obviously a school of thought that is not one person's view. It's just a complete misunderstanding of how value is created. And it's a huge problem, because it's like, I don't think you can make good decisions if you don't understand how the world operates that way, or how money moves around, or how value is created, and to take issue with how much people are getting paid and make suggestions about how to fix it without understanding the source of funds is just completely moronic. Right? It's like it's like completely nuts. Like you're presumably like writing papers and giving advice and making assertions like this is how we should fix X, Y, and Z, but you have no understanding of the underlying fundamentals of the situation. It's
right.
Very bizarre.
They're giving like this individual and probably his colleagues are giving advice to government bodies on how to spend tax expenditures, for example, right? And how to set tax policy. You're right. It is. So I'm not going to call the author out by name, but I did do a little bit more snooping. And so he tweeted something out. And in the tweet, he says, for all the people kind of making fun of, I'm paraphrasing it, for all the people making fun of my take in this article, he says, listen, that just kind of proves the article's point is like, data can change how you look at the world. I'm like, that's a bit of a stretch. But then he goes and finishes, this was the kicker. Where I grew up, rich people were athletes, movie stars, and like actors. I'm like, bro, where did you grow up? Hold on.
Were you in Hollywood or what? Say that again. Actors, movie stars, and what?
And athletes.
There's only a couple places, mate.
Yeah, dude, bro, literally, where did you grow up? Did you grow up in Brentwood, California? This is where. Did you grow up where they film? I mean, literally, right? Did you grow up with the Kardashians?
Sometimes you're all three of those things. Yeah.
Yeah, sometimes you're. Anyways,
no, it's staggering. It's staggering. It's like truly bizarre, and to obviously, you're near the top of your field if you have permission to like put your opinion out and broadcast it under the banner of the New York Times. So you're not the only person that thinks this way. It's nuts, and I think it's just so unfortunate that like thinking is so pervasive. And again, like when challenged, it's like, oh, I just thought athletes and movie stars were rich when I was growing up. Like, that's really how you're going to defend this? That's a joke.
Yo,
Jack is so pissed. Jack is fired up, son.
Very annoyed.
I am pissed. But it's like, it's also the shift in worldview you have when you're responsible for a P&L. I think you can, I think Taleb's got some of the best writing on this. It's like, don't tell me what you think, show me what's in your portfolio. Or like when you have a P&L to manage, your margin for bullshit shrinks massively, right? You're not just being paid to show up or like type words or, like here's your contract for X number of years. And I think, I don't know, I can't say this with any certainty, but in like education, my like understanding of how tenure works is like you're locked in for a certain amount of time. Your salary's coming.
Do whatever you want.
So you can spout anything for decades and you're good. So I think a lot of that does come down to like how people feel or how they think the world works or what they saw when they were 8 years old or whatever the like extrapolation is in this case. And you're like charging people hundreds of thousands of dollars. To bring the point back to what we were talking about at the beginning of this episode was like, you could go and find somebody on the internet that's built $1 million business and pay them a couple $100 to learn how they built it. Or you can go to Harvard and spend $200,000 to have a professor of economics that doesn't know that value is created by inventing things, making things, distributing things.
Jack is
honestly lost for words. I'm lost for words.
Wait. That shake, the head shake was so good. It was I
don't know what to say. I just don't know what to say. It's like, I will say we're in a collective hallucination, thinking that like worshipping those, like that school of thought. It's just wrong, like completely backwards and incorrect. Bizarre.
Yeah. Well, I was going to say, even if you don't pay, I mean, literally, the way we all met is through, I had a podcast. I interviewed a lot of those people, including Jack. We talk about for free exactly what he did to make over $1 million a year in his business, right? And it's like that's exactly why I love doing that sort of stuff. It's just you get to actually learn the ins and outs of what people are actually doing today, not just the academics stuff in a book. Mm-hmm. And obviously, look, there's a place for certain types of academics, obviously. But like when it comes to money specifically, it's just something you can't necessarily just learn in a book that was made 10. Like the syllabus was from 15 years ago. It took 5 years to actually get printed. And by the time, like all the stuff I learned at university, is mostly obsolete apart from like 3-4 big principles and learning how to use JSTOR, like the academic journal site or whatever. You know what I mean? So anyway, so that was the rant of the week, and definitely a good anything else, Trung or Jack, on that before we move on?
I'm so happy. I was a little bit like, do we really need to do this? And then after seeing Jack just go absolutely just Terminator on the topic, I'm like, yo, what else? Wait, Bilal, what other academic study can we put in front of Jack next week that will just get the head shake?
We got to get that guy as a guest, man. Hear his side. And let Jack go red pill.
I'm sure he's a nice bloke. No hard feelings.
No hard feelings. You know what?
100%.
So my last thought is this, and let me add this as somebody that writes for a large financial institution that does not control the headline or the social tweet. We talked about this before, right? With Bloomberg and the can of the bean. What was it? What kind of beans was it? Lentils? Yeah. Dude, you don't control the mess. I mean, here's the thing. Like the article. Actually, you know what? I take everything I said back, and I'll tell you why. The problem with that article was in the body of the article. Right?
You were saying normally it's the headline, but in this case, you're like, no, actually the body had some issues.
Usually the headline and the headline in the tweet, right? The reality is that 99% of people will only see the headline and the tweet. And let's take the perfect example. The recent article about Elon Musk as childhood in South Africa that New York Times published. So the article basically said in a number of instances, Elon Musk was not a racist. His father was in an anti-apartheid political party. Elon left South Africa because he didn't want to be conscripted by the racist army. Elon stood up for his friends in high school that were black, and he got beat up for it. So the article, that was in the body of the article. What did the tweet and the headline say? Effectively, Elon Musk is a racist because he grew up in apartheid South Africa. And then that would be the opposite of this situation where everything is like Dare posted it, right? It just took this long. Think about that. He took a long piece of writing this long. We all are on Twitter. Nobody reads that. People started reading it, and that thing goes viral. They're like, this is insane.
I struggled to read it just now on this podcast. I started sounding like Floyd Mayweather.
Like,
yes. sorry.
We should actually, it would be funny to, I mean, not funny, but like, I would let the man explain himself. So there's a man, and maybe he's listening. If you are, message us.
I will say I didn't see it properly, but I'm pretty sure he posted a few tweets. So I was like, oh, fair enough. Like he's trying to show what Jack mentioned before, he kind of was using an excuse, but there were a few things where he was kind of accepting how ridiculous it was that he's got a PhD in economics. But fair play to him. Yeah, fair play. Exactly. Anyway, you go on, Jack.
Also, like, it's not like there are levels of approval, I'm assuming, in that going out.
That's a good point.
He wrote it. It probably went through editor. Yeah, that looks good. Another editor. Oh, great. Yeah, excellent. Bang that. Put that on the top. Put that on the front page, guys. We'll stand behind that.
Yo, how lit is Jack? Yo, Jack, this is Jack. Episode 55, man. I have never seen you get so lit about something before.
I just think the ramifications of, I mean, it's also encouraging that the response was so like visceral too, right? Because obviously, like, it hit a nerve with enough people that we're talking about it. So maybe it isn't a, like, when these theories make contact with reality in a lot of cases, it's like, oh yeah, that's clearly wrong. But the problem is how far it circulates in a closed system, and how many people believe it, and how many people go out into the world and can't make an economic impact because they've been told the only way to make money is to be a fucking basketball player or a movie star, or it's like, probably not going to happen for you guys. Owning an auto dealership, or like, you know, selling tiles or something, or building some like regional
beverage distributor. Guess what?
Right.
I know some beverage distributors. They rich.
Mate, there's guys around here cutting grass and own, you know, a few trucks, and like have got the most sophisticated advertising operation I've ever seen for a grass cutting business around here. They are probably, you know, doing all right for themselves. It's just a really interesting divide, right? And like, where the academic lens on value creation is so different than, well, not even value creation. It's just like money. Like obviously,
yeah, because you could argue there's obviously other ways to create value in society beyond money. Though money is obviously a direct. People only transact if they are gaining value in something. But at the same time, I completely agree. Like speaking to other people, especially honestly academics, I have a few friends who have gone down that route, and sometimes like it's such a struggle to talk about it because they value all the things I don't value. Right. And like, it's all about, I'm obviously generalizing, but the credential, the tenure. Whereas for me, my background has always been, you're telling me I'm going to take 10 years to do something. I might figure out a way to do it in 2. And I'm still going to do all the work and everything. But maybe the 80-20 of this is I didn't need to do all these other steps because you had to go get people coffee, and therefore you're going to make me do that for 3 years. Maybe there's a better way to do it. So I think like the very conventional way of thinking about it, the kind of like takeaway I got was that one line: first, rich people own. Like again, we've talked about it many times. You referenced Taleb there, skin in the game, basically, right? That is the kind of macro point. The micro point, though, for me was beyond, and this kind of made me think about it as well, was those examples: beverage distributor, auto dealer. Yeah, honestly speaking, when I think of someone who makes $1 million a year, I don't think of that either. Though I know those people do make money.
Think, you know what? I think of, to your point, you're right. The first thing that obviously comes to mind, okay, let's give this guy a little bit of credit. Yeah, if you're asking me what's rich, I'm like, yeah, probably actors, movie stars, Silicon Valley execs, right? I get that. But as we were talking about, I also know these other classes of individuals. Like, I know the dude that makes 7 figures as a, like, he ships lumber around the city, right? Not our lumber trading, but literally just like lumber as a developer, a real estate developer, right? So I actually wanted to pull up the exact headline. So how egregious is it actually? Here it is, boys. This is the actual headline.
Do you want to read it out? I can't see.
Yeah. The rich are not who we think they are. So that's the first part. You know, that's a good headline, but that makes you want to read it. But the body of the text, much like the Elon one, does not support it. But it's not as agreed to. The Elon one was literally just race baiting. But then the other part of the intro goes, or the headline goes, and happiness is not what we think either. But here's the thing. So he does a whole part about happiness where there's a study, the famous study where like your happiness level's at 75,000 and it doesn't really increase from there. So
the diminishing returns of happiness.
That's not really that true.
It's also a very broad statement because 75K in New York is very different to 75K in Alabama or Malawi. You know what I mean? So
let me just wrap it up. I'll say this. The entire time that we were talking, I'm like, oh, how are we going to put this into a thumbnail or headline? But we should just call this section NYT headlines. People will want to read that and listen to that because that's what ultimately this is.
I also think like the last closing point is the like credentials don't rid you of your bias, and everyone is biased in one way, shape, or form, regardless of whether or not they care to admit it or are ever like challenged to admit it. And this person has like run into an instance where their bias has been like publicly called out, but we're all guilty of it to some degree. It's like writing an article is not there's plenty of stuff that goes out that's like not irrefutable. You know, 99% of things are opinions or poorly worded versions of the truth. It's fascinating to see. I think weirdly, like we're in this I think with all the Elon news and everything else happening, and I think culture in general the last couple of years is way more interested in money, investing, income. Like everybody's feeling like they have to go and do something, take like control of their future financially because of the external forces that are at play or have been at play the last couple of years. So I think people are like tension is running high in that area in general, and maybe people are just examining it harder than they ever have before, and they're finding things that they would just like challenge their original assumptions in that world.
And also, Jack, to add to that, I think we're also in a world where, on the flip side, there's like an anti-money, anti-billionaire sentiment, like the phrase "billionaire should not exist" sort of thing. So yeah, anyway, we could talk for an hour about that. So let's move on to the next topic. But anything else before we close it out?
No, that was great.
Good chat.
Jack,
All right.
wait, Jack, are you okay? Are you okay, dude? You want to breathe there?
I'm good.
Yeah.
I'll get a glass of water.
Needs a glass of water. Let's give him a time
Again,
out.
these are not personal attacks. I want to make that very clear. These are not personal attacks. It's
It
more
was your
like
feeling about the institution and this whole line of thinking.
And it's just fascinating how different the world looks when you have a balance sheet and have to take risk by yourself. And I'm not saying that's right or wrong, but you shouldn't be making assertions that aren't true if you haven't been on the other side of that equation,
100%. All right, boys, let's move on to the next topic here. Good chat. So, Edge of the Internet, this is packed agenda today. We're going to be talking about follow-up to Terra, and Trung's going to talk about the dream of algorithmic stablecoins and how that's still a thing, even after the Terra UST collapse. We'll dig into some stuff Vitalik's been talking about on some contradictions that he kind of wrote out publicly, which we thought was really interesting. And A16Z, Andreessen Horowitz, one of the top VCs in Silicon Valley, talked about the crypto price innovation cycle. We're going to talk about that. And then if we get to it, Jack is going to give us a little taster of a new NFT project he's really interested in sharing with us. So, boys, let's kick it off with a Terra follow-up. I know since to put this in context, we recorded last Tuesday, basically Tuesday evening Eastern time. By the time we finished, we put out the next morning, Wednesday, and we even said in the episode, by the time you listen to this, Terra could go to zero, and pretty much that's kind of what happened. Even my girlfriend, I told her about Terra some time ago, and she was like logged into Coinbase, and she's like, "Oh, it's gone to zero." I felt a bit bad, but yeah. So that happened. Oh, you're on mute, Trung.
Trunk's going. Hey.
Trunk's going.
Wait, you shilled Terra to your girl?
I didn't shill. We talked about it.
Wait,
I didn't shill it, but.
Not investment advice.
100%. 100%
Okay,
no investment advice.
As we're talking about that, well, people, before I continue to grill Bilal, because he's not done yet, I want Bilal to continue to walk through what happened. First of all, we got up to number 36 in the investing category on Apple's.
In the US, which is big.
No, it is big. It's kind of crazy because the investing category is very difficult to crack into. But we're also called not investment advice.
I mean, the only logical conclusion is this will be number one investing podcast in the world.
It has to, right? Dude,
most entertaining outcome.
Okay, so Bilal, you had mentioned it as pillow talk.
Yeah,
You're like,
no.
Heard about,
that's our pillow talk.
Hey, I heard about Luna. You might want to check it out. So she buys some Luna.
No, it was a small amount. Okay. But yeah, the context is, again, without disclosing all of her positions, but she's a business, but she's got her own business. She's working crazy. She's got money to invest. And she just asked me, what do I do? And I'm like, okay, this is my opinion. You follow what you want to do. Put this in your, Roth IRA, or not Roth, but, SEP IRA, whatever. Invest in indexes. That's your safe money. Automate it. Dollar cost average. Don't think about it. And she's amazing at doing that. She doesn't overthink it. But then in crypto, she hears me in the other room talking about it every week, right? So then she sees me walking around London right now with the Step-In app, where I'm like the walking Ponzi app, basically. Nice. And so she's obviously interested as well, and she kind of believes in it enough to have invested a small amount. And yeah, so she was like, outside of Bitcoin and Ethereum, what else is interesting that you think is worth doing? So I shared Solana back in the day, Terra. I was like, okay, this is interesting. I don't know if it's going to go to zero, but this is the risk you take. So anyway, that's kind of it. I think those were the only four.
And then Bilal goes, and long story short, we're no longer together.
Yeah, I mean, it was definitely a difficult discussion, but no, she's completely fine with it.
Terra,
she said I got charged that to the game. I was very proud.
Yeah, amazing. Okay, so Bilal, essentially the two tokens associated with the Terra ecosystem, Luna and the stablecoin, the algorithmic stablecoin UST, they both are effectively zero now. UST went from 20 billion to 1 billion, and Luna went from a peak of 40 billion to 1 billion. And even then, it's like whatever money's left in those systems is like, it's probably Do Kwon holding it, right?
Yeah, I don't know. I think there's like what's going on now? There's like a discussion happening publicly, like
Right.
what should happen and how they're going to make good to certain people. And I haven't followed that fully, but what was there anything else that happened? I mean, basically it went to
Vitalik
zero.
talked about it. Vitalik said, this is his tweet. He says, Terra should focus on the poorest 99.6% of the wallets. So these are individuals with probably less than $1,000 that they had put into it. And he's like, the Terra ecosystem and Do Kwon should pay these individuals out and like forget about the whales. I think the opposite ended up happening. But another viral thing that went around yesterday was that Vitalik had more or less said, the precedent for this is the FDIC, which is the Federal Deposit Insurance Corporation in the United States. They guarantee every bank account up to $250,000. We talked about it last week, and how Giannis Antetokounmpo has
82 bank accounts.
82 bank accounts. Smart. So that's where the situation is. It did go to zero, as you mentioned. Last week we said this definitely could happen. It death spiraled to zero effectively, a $60 billion wipeout. But actually, let me take that opportunity to talk about algorithmic stablecoins. Why, even after this wipeout, it's going to keep happening. So this is the largest wipeout in dollar terms for an algorithmic stablecoin. The last really famous one was Mark Cuban. Remember how Cuban was pumping Iron Finance's Titan? Would you guys remember that? Do you guys know the details about that?
I think we covered it on the pod.
You remember the meme with the bike and the stick, and he's like, buy what was it? Buy Iron Finance, $19 trillion APY, and then he sticks the stick in the front wheel, and then he says, "We need regulation now."
Well, that's such a great point, because I'm going to bring it up, because he also talked about regulation after Terra. So the algo stable coins keep coming up. Okay, so last week we briefly touched on it, but let me kind of lay out the field again. So this is the overarching thesis for the listeners and viewers. So I wrote an article for Bloomberg, and as we joke about in our group chats, no one that listens probably has a Bloomberg subscription, or such a small percentage, so you probably didn't read it. So I'm going to talk through what the article talked about. But the headline, you guys want to talk about a nice headline here? It goes, "The dream of an algorithmic stablecoin won't die." And here's why it's a dream. I spoke to John Wu of Aztec Network. I don't know if you guys, he's the one with the super viral thread when this thing popped off. There's the one you guys were sharing was from John Wu.
Yeah. Oh, nice.
And yeah, he's a legend. So I spoke to him after his viral thread. Packy published something in Not Boring that he wrote also, basically an expansion of that thread. But he was explaining to me why algorithmic stablecoins keep getting made. So uncollateralized algorithmic stablecoins, which Bilal talked about last week, are they're basically collateralized by the underlying token and some mechanism, quote unquote, the algorithm, which will burn and mint coins to keep the peg. Whereas Bilal talked about last week, something like Tether is backed by treasury, securities, and money, right? So there are four ways that you can basically create a stable coin. You can do it with Bilal alluded to treasuries, fiat. You can do it with commodities, so you can do a gold back. So Tether has a gold back stable coin. You can do a crypto backed stable coin. So Maker is crypto backed with Ethereum. But what happened with Maker is that because Ethereum is so volatile, they over collateralize basically 2-to-1. So it's not very capital efficient. That's the way that John explains it. He's like, well, Maker, to mint $1 of DAI, you need $2 of collateral. So it's not very efficient, right? An algorithmic stablecoin with no collateral, uncollateralized, is very efficient. You can mint a $20 billion stablecoin, essentially, which is what UST ended up being. And obviously, a big part of that attraction was the 20% APY that you could get by staking it. But his whole point is these type of stablecoins are the holy grail of the crypto industry, because they act like fractional reserve banking in the real world. You go to the bank, they can lend out 9 times what they have in deposits. Like that's what the U.S. government lets them do. He says essentially that algorithmic stablecoins, uncollateralized, are kind of this dream. And in his perception, and I kind of agree with it, is like people will always try to make a better mousetrap like this, right? And there will always be a VC or an investor being like, oh, you're going to try to print money out of nothing? Yeah, sign me up. So that was his explanation. So I asked you guys, how do you feel about that larger thesis where it is basically a greed argument? There will always be some party that will say they have a better mousetrap and people will fund it. Thoughts?
Well, Trung, just before we say that, I was going to say my favorite reply to your article, I think when you published it, someone wrote, this sounds like US dollar. Like they read something about like backed by nothing, can print as much as you want, and they're like the US dollar. Obviously, that's you can argue that all day.
Well, the US dollar has the Keita Breer tweeted something hilarious. He's like, this is why the US dollar is valuable, and then he just had the aircraft carriers and the missiles.
Oh yeah, yeah, that was good. That was good. Yeah, I mean it's only backed by the empire of the world and the number one military and the number one economy, of course.
Violence, right?
Completely. Yeah, that's the main thing. But yeah, Jack, anything from you, mate, on that side?
I think we covered most of it last week. It's Trung summed it up. It's like you're trying to break the laws of economics, as we go back to our last part of the
Jack's still fired up. Don't.
Yeah.
Jack's about to let loose.
I think the most frustrating part of it is this, like a incident of this size is going to bring so much criticism to the space, and many people who are trying to innovate responsibly will, get caught up in, or painted with the same brush as people that are clearly building things that are like very, very volatile and extremely risky versus like trying to add utility to a system in an ethical way, which, USDC, I think, there are a couple of stablecoins that are as stable as they could possibly be backed to instruments that are recognized as stable in the fiat world. So I think it's like the point of attack for the crypto ecosystem that I think regulation will come after the hardest. And Trung, you've probably spoken to people about what that's going to look like too. But it's so obvious that is like the attack vector for that is like these investors thought they had $10,000 and now they've got zero. It's not like you bought like ladder token and it's suddenly dropped 90%. It's like, yeah, you knew what you were getting into on that one, right? But anything that's got USD in it
and stable, like the word stable.
Yeah. Well, let's bring it up. Vitalik says, we showed it in a tweet, he said we shouldn't call these stable coins. Algorithmic stable coins should not be allowed to use that name. Mark Cuban said the same thing. I mean, we joked about him getting burned on Titan, but he said about in the aftermath of Terra, he tweeted, where I think regulation is absolutely needed. Sorry, guys, laughing, thinking about that meme that Jack said is absolutely needed stable coins. And he said algorithmically defined stable coins tokens should not be stable coins. Last thought I'll have is John Woo, who interviewed for the article, made that viral thread. He says that the industry needs a internal norm of disclosures. Like people should be willing to accept that. Like, listen, it's not enough that you say, "Hey, trust us," and here's like a Git that you can go read everything. It's like just be crystal clear what is going on, right? And I actually think that brings up. We mentioned it briefly. We actually didn't say it in the intro. Bilal, I think we should just like make a 30-second proper intro. But Michael Saylor versus Raoul Pal is
let's just explain what it was. We didn't explain it, but those two had a conversation. What were they talking about?
So Michael Saylor, obviously Bitcoin maxi. Raoul Pal, also a well-known macro investor, is deep into Ethereum. Is this correct?
Yeah, I know his biggest position, but he's not. I wouldn't say he's like an ETH maxi. He's kind of like that was the opportunity. He saw the biggest opportunity, and 6 months ago, anyway. I'm not sure about now.
So where him and Saylor had this conversation last month on Real Vision, which is Raul's channel, was essentially around what are the levels of regulation you should have. So Michael Saylor's actually been on a bit of he's been on a media tour for the last 18 months. But his recent one, including the Lex Friedman podcast, he did talk about specifically why, Lex asked him, why is it okay for you to talk up Bitcoin, right? Because he's critical of Ethereum boosters and other token boosters. And Michael Saylor's position was this. He's like, I don't actually control anything about Bitcoin, right? Like fundamentally. He's like, I can't issue more Bitcoin. I can't burn any supply of Bitcoin, quote unquote, like you would mint and burn another type of token. So he's like, it's a property, and that makes it ethical for me to talk about it. So that's his position. Whether or not I agree with it, that's his position. He says, however, it's pretty clear that most tokens, if you apply the Howey test, which is the 1950s SEC test to judge whether something's security, and basically, do you invest with an expectation of return? I think with most of these tokens, the answer is yes, right? Which makes it a security. And then he was telling Raul, he's like, this is the problem with these tokens that are securities but don't have regulation on them. He's like, guys like Do Kwon or anybody else, and he used the word compatriots, could just issue
underused
tokens.
Word. That's an underused word, man. Yeah.
And print, tokens as they please. They might say, hey, we have a certain protocol and these are the rules, but at the end of the day, they control it. And he's like, that's the difference with Bitcoin. I can't change the underlying. I'm like, that's a pretty valid argument, right? He's like, that's very different than if you had issued those tokens. And he always says, like, if I issued Michael coin, I could just give it to all my buddies and then keep printing more if I wanted to, and then dump it onto retail. And I think Raul's point was like, oh, if you put too much regulation, you'll slow development. That was his point. But I think the Terra thing is like, it's a gotcha, right? It's weighing back into Saylor's point. So happy on your guys' thought on why Saylor thinks it's ethical for him to talk about Bitcoin, if you agree with that.
And just to clarify what I heard, so if I understood this correctly, the summary was that because he can't personally, he's not the creator of Bitcoin, and he's not someone who can personally impact things too much.
Like the supply of Bitcoin or the mechanics of the protocol.
Therefore, it's decent, and it's the most decentralized crypto. He's not going to have a tangible effect on it. Is that what you're saying? As
like literally, he can't just snap his fingers and decide
can't manipulate
to change
anything about
the way
it, right?
The creator of
like
Terra
he can
could.
pump it. He can pump it verbally, but he actually can't change the underlying of it, right? So how do you feel about that?
Jack, any thoughts?
Yeah, well, I think that as a blanket, like saying that that's the case in the case of every other crypto asset, depending on the context, is not true in a lot of cases, right? Like an Ethereum is still, and Ethereum is still that. Yes, there is an Ethereum foundation that decides to change the way Ethereum functions, but it does have to be adopted by the entire network in order to continue. So I think the more established projects, Bitcoin obviously sits in a different category based on the fact it was kind of, it was created by somebody who disappeared. But at the same time, I think changing Bitcoin is not that dissimilar from changing Ethereum going forward, right? It still has to be a 51% of the network agreeing to run that version of the asset. But I don't have a problem with anyone. I think his point about ethics is bang on. It's like if you're purely manufacturing a narrative to exit an asset, that's very different than people who are
just promoting or
trying to change people. Trying to change something more fundamentally, I think based on everything he said in public, it's like he's trying to get Bitcoin as corporations to hold Bitcoin on their balance sheets. Like we need a new global system of accounting is very different than put all your money in, Shiba Inu Dogecoin. And then when it's, in 20 days, we're going to exit out of that. So I think it's definitely more of a philosophical difference than maybe it is just and philosophical / ethics, maybe that falls in the same camp. But I do think people outside of the Ethereum ecosystem entirely don't give it a fair shake a lot of the time because, you tar all of the blow up outside events with the same brush when there are plenty of
they just call them all altcoins. basically.
Right. Yeah, and I think the interesting thing is, at least from my perspective, is Bitcoin has one feature and it does it really well, right? I think like these other assets are trying to accomplish different things, and I think the way in which you assemble people around that thing has to be a little different to accomplish that thing, because we've acknowledged that this thing isn't finished and we want to improve it, versus a Bitcoin where, you know, all of the building for the most part is happening on layer 2s, Lightning, wherever else. So I think it's interesting. I think I don't think he's necessarily arguing for them to not exist. It's more of a
he wants regulation. He says he wants disclosure, because he keeps on bringing up. Let me add to that. You're 100% right. He's not saying they shouldn't exist. And his argument with Raul was like, I just think they should have disclosure. Like, I run MicroStrategy. Anytime any material change happens to the company, I found 8K, right? And I have to do quarterly auditing. He's like, we're probably gonna have to have that type of norm if, to your point, Jack, is like, these are unfinished products, right? People are developing things. So there are going to be material changes. It's like, if Zuck decides to make a material change at Facebook, he needs to file an 8K. None of these projects have this internal norm of disclosure and disclosures and filings.
And I think in a lot of cases, they don't even know what to disclose, right? A lot of it's so interesting, the ratio of people with an idea versus like people that are either trying to rebrand something or just market something differently. Like the stablecoin is a meme, basically. It's like, which one can you attract the most capital to? And then it becomes more stable as a function of your ability to attract capital to it. But I think, I really don't understand enough to know how like a Terra, like a coin that claims to be like stabilized through an algorithm, like versus like if everybody wanted to redeem all the money in the pool at the same time, if that money doesn't exist, then that is not a trustworthy asset, right? That's just a pretty simple.
They need to stop calling it stable coin.
Yeah, I was going to say, I agree with that 100%. I think the word stable it's just too, like, it's a very specific thing. It's implicit in its name. This isn't dropping 90%, which in this case, it dropped a significant amount, right? So, and that was actually honestly the one that's sad. I spoke to quite a few people in the last week and a half, like since it's happened. Some people were really early in Terra and they lost literally millions of dollars. There were other people I know who are, have a modest income and they got really interested in this stuff. They've gone down the rabbit hole, like basically similar to me. And they put a decent amount of money in their savings account equivalent, Anchor Protocol. And look, when you do that, there's risk, right? But at the same time, it was $15 billion or whatever it was of deposits. I can't remember the exact number. And the number of people that were involved with that, they were like very significant names. It wasn't just like complete random Joe Schmo in there.
Novogratz has a tattoo on his arm.
He's got a tattoo, exactly. So, and it is a little sad because I'm actually meeting one of them tomorrow. I'm curious to hear how it's gone for him. But yeah, it's just again, all of us know going into this stuff, whatever you put your money in, you can expect it to go to zero. But when it happens, it still kind of hurts, you know what I mean? Like we did a whole podcast on the bear market, and the last 3 weeks have been absolute insanity, right? Like for everyone, I know we talked about philosophically focusing on building, focusing on skills, all those things, which I 100% agree with. But when you see, to put it frankly, like many years worth of savings essentially drop for me in particular, that is a very difficult thing to take, right?
Tough.
And I know I'm not the only person that's going through that. Pretty much everyone is probably listening to this. But, that is kind of part of the game, I guess. And you kind of, I felt more prepared this time, even having spoken to you guys about it on the podcast, saying when it happens 50%, 80%, which is basically Bitcoin and Ethereum have dropped 50%. I think they could go all the way down to 80% based on previous drops. But basically, I still haven't sold anything, right? And I'm literally moved my stuff to cold storage again recently because I was like, I'm locking it away. I'm gonna lock this away for another few years, man. The way that I said I would. That. Yeah, but let's see how it goes. If I really need it, I mean, it's a different story. But anyway, there is actually we won't talk about this week. Maybe I'll do it next week. There was a great thread from Punk6529 on basically the psychology in a bear market, and I thought it was really poignant. There was a lot of really good tangible things in there that even helped me. And one of the things I remember was basically that big number that you've had in your head, your all-time high net worth, savings, whatever that number is to you. Just let go of that, man. That is, I know it sounds obvious.
That's a Kobe line. He's like, you can't have whatever your max net worth was, you can't pin it to that, right? And
also, and again, this sounds really obvious and kind of sad to say, but like your worth is more than your net worth, obviously, right? But of course, when you've got kids and you've got plans for a future, and that is part of that, that's difficult to take. So it's been a really, really difficult week for a lot of people. And I will say, in fact, I'll even link to that in the show notes because I think it was worth people reading. And maybe next week I'll go through some of my favorite points in it. But yeah, I mean, to cap off what you said, Trung, on the Sailor stuff, I 100% agree in a way on the stablecoin side. Like that word shouldn't really be used. I think generally some regulation is going to happen 100% / needed, right? Like the good project should pass a certain threshold. At the same time, we know that kind of stunts the growth of like an innovative industry. So yeah, that's kind of the trade-off. But you'd also want to make sure that some people have protections when they've got a couple $100,000 sitting in an Anchor protocol or 10,000, whatever it is, because there just needs to be more kind of protections for those people. We can move on to the next part. Unless you guys had anything else on Sailor, I did want to bring up SBF, who had another take on this.
Actually, I thought it'd be a great, you're talking about the sell-off. I could just do the Andreessen Horowitz chart really quickly.
Oh, yeah, let's do it.
So Andreessen, Bilal, you're mentioning the different sell-offs we've been through, and obviously we had a big drawdown in crypto now. I think 2 trillion of wealth has been, maybe $1 trillion. I can't remember what the number was. But Andreessen Horowitz, the venture capital firm, had their first state of crypto report come out today, which is a Tuesday, May 17th. But the part I wanted to talk about was they talked about the crypto price innovation cycle. So we talked about this briefly many, many episodes ago, but they framed it beautifully. They're like, there have been 3 big cycles prior to this for crypto. So 2009 to 2012, that peaked at in the year 2011. So that's over here, really early, right? I think what's the peak price of Bitcoin here? Still under 5,000. But like, you know how Bitcoin had that first run? Nobody really knew about it then.
I think it wasn't even a few hundred back then.
Yeah, probably a few hundred. Like this line's not even up yet, right? Look at it. So that's the peak of the first cycle. And the first thing to come out of that 2009, 2012 period was obviously Bitcoin. That's when the real kind of technologists got interested. So Andreessen said that the exchanges, miners, and wallets were founded in that period. And then they talk about the next period, which is from 2012 to 2016. And this peaked at 2013. I think, Bilal, you're correct. I think this one might have started touching the 4-figure part, but maybe even high hundreds, right? Maybe low thousands, high hundreds. And then they said this is 10x the interest now. Still not mainstream, but Ethereum, for example, was born under this period.
And do you know, Trung, when they say interest, do you know how they're measuring that? Did they mention that?
So let me go back to that's a great question. I should have talked about that first. So they charted kind of the cycles of Bitcoin into 4 buckets, and the buckets were social media activity. So they look primarily at Reddit and Twitter mentions, and then the next category was startup activity. That's how much funding there was. The third category was developer activity, which is around GitHub, Git commits, and a type of engineering.
Oh, that's great. That's a great 3.
Cool, isn't it?
Yeah,
it's really cool, actually.
Right?
Yeah, and if you're listening to this, I'll just say, click on the YouTube link in the show notes, and you can fast forward to the timestamp where we talk about this, because the visual is actually very helpful.
It's very interesting
to understand this.
So, Bilal, thank you for asking. That was a very good to clarify there. And then the third cycle, which this is to their point, this is when it finally reached the mainstream, and it no longer was a fringe technology, but it received, a lot of startup funding. Like people were really interested in this category as a startup sector. That phase between 2016, 2019, obviously 2017 was the peak, that crazy Christmas period. And then out of that era, you had OpenSea, you had Dapper Labs, you had Axie Infinity. And then they're basically saying like these crashes happen. They had a very cool photo here. But yeah, I'll just walk through it. It's 4 points, but they said the price goes up, interest comes in, brings new ideas, the price crashes, but then all those new ideas that the shakeout you have from the interest, a couple of them will stick around, right? So we're clearly kind of on the downslope right now of the crypto. I guess now it's the fourth phase. Hopefully it won't last that long, but cool stuff will be made. And I think that's interesting and a good addendum to what you're talking about, Bilal. Is like we're going through it again.
Yeah, and the other thing, that was great, by the way. Thanks for sharing those that visual. I think Pomp was talking about this, obviously, as it relates to Bitcoin, because he mostly talked about Bitcoin. But I think Bitcoin has had a 50% drop. This is in terms of price, obviously. We're not talking about wallets, all the other things that you mentioned there, but just the actual price drop has dropped 4 times before 50%. In fact, I think March 2020, didn't it drop like 50% in one day or something? It was a crazy drop.
Yeah, it's huge, 30 or 40%, I think.
In one day. And overall, from this all-time high, dropped 50%, 4 times before. This has happened again recently, and it has gone all the way down to 80%. So you can do the maths from, was it that the high was 69K for Bitcoin? Fittingly, and almost 5K for ETH. So you could do the 80% drop to that. I guess it takes it to 1K ETH and I can't remember, 17K or maybe 12 or something like that. Yeah, so no, but I mean, that's good to see again. That doesn't mean this will happen again, but good kind of number to have in mind. The one difference we're seeing now, though, is this is the first time Bitcoin, Ethereum, any crypto has gone through basically a recession too. Because since Bitcoin's been around, it's been, money go up
only,
right? And we've had money printer go up as well. And so this is going to be a very interesting challenge to see, does it behave in the way that it did previously? Are we going to have a few year bear cycle and then we hit the bull run again? Again, just my opinion. If there was never another bull run again, I would be incredibly shocked, because that's just the fact that each time, we talked about in that bear market episode, but each time more people get involved, they understand what's happening, the meme strengthens, stronger, and that is, so it doesn't mean tomorrow it's going to be a bull run again, but if there's never a bull run again, that means crypto didn't work, right?
Yeah, I'd be shocked.
That would be a huge shock for everyone. Advice. Yeah, not exactly. And for everyone listening to this, I'm sure you probably think the same. I did want to also bring up one other point. We shared SBF, Sam Bankman-Fried, founder of FTX, had a great thread about Terra straight after this all happened. This was on May the 15th. And we don't have to read through every single tweet because it's a whole thread, but there were a couple that stood out. Tweet number 10, he said, most bad investments aren't Ponzi schemes. Some are fraud, some are bad luck, and some are somewhere in between. And this was in context comparing Terra to Theranos. He said, here are a set of investments that would have lost you more than 50% since the start of the year. Netflix, Luna, AMC, and ARK. Right, so obviously 4 very different things. Netflix we all use. Luna is this now shitcoin. AMC, meme stock. ARK, Cathie Wood's ETF growth got hit on the growth side. So I do think that was quite an interesting frame. Again, not defending anything that happened with Terra, because I think there's people who are kind of digging into that and are finding something that seemed to be a little dodgy. But there was one other thing he mentioned here, which was Luna was a case of mass enthusiasm, excitement, and frankly, marketing and memes, driving people to believe in something which was going to falter according to publicly available information. That marketing was probably bad, but it wasn't the same type of bad as Theranos. And so, reading that on the first day, I thought that was actually quite a good frame for it. Though since then, like I said, people are digging in, seeing, again, I know this is all alleged right now, but the way that they were selling Bitcoin because I think that was it 10,000 Bitcoin they had, and they sold a crazy amount of this. There are people digging into that and saying, was this done in an ethical way? Were they basically selling it to whales? Was it coordinated, et cetera, et cetera? So I don't know anything about that. So no one come for me. But I do think that was an interesting frame around when things, basically everything's being called a Ponzi and people calling Luna a Ponzi. I think the Ponzi-nomics of it were definitely evident, but does that make that a full-on, Ponzi scheme, right, where it's just a straight pyramid scheme? Again, I don't know the definition of what that actually means. I'd have to dig into that a bit more. But yeah, was there anything else? I think us three talked about the SBF thread. Was there anything else to mention from him before we move on?
The last thing I'll add is this morning he did say that there's a tweet from one of the U.S. senators basically saying, stablecoins need regulation. It's like, if you're claimed to be a stablecoin, show us the books. What is backing the stablecoin, right? Because
this was about Tether, though, right?
I don't know specifically about Tether, but no. Well, I mean, if you're asking what's backing, right? It's like what is in the. I don't want to say it out loud because I don't know if that's exactly what he's referring to, but makes sense that would be something they are referencing, right? But he's like, yeah, it just needs regulation. I think it's more overarching too. Is like if algorithmic stablecoins are regulated, well, they have no backing, so let's stop calling them stablecoins. And yeah, I agree. I think, Bilal, you're correct on what kind of asset and token they're talking about.
Yeah, and again, this is literally in a sorry, Jack. Just one thing on that. In an investing WhatsApp group I'm in, someone shared a message earlier and said, "Hi guys, a judge blocked a request by Tether to hide its reserves that backed the coin. Wouldn't be surprised. The rest is speculation, so I don't want to read that out. But that was where I'd heard it. I don't know if that's actually true, but he's normally pretty on top of things. And sorry, Jack, you were going to say something there.
Yeah, I think his framing of it, of like, is it fraud? Is it, is it just like, there's a very, man, I think it's a big short line. Show me the difference between illegal and idiotic, and I can't remember the exact context of it. But when you make the comparison to Netflix, though, it's like Netflix puts out a product, right? It's like even if Netflix stock drops X amount, like they still, even if the content you don't want to watch it, it shows up on your TV every day. Yeah. Like your only job as a stable coin is to be worth X, and if you fail in that job, then your product it failed, right? Like that is not what you said you were selling. And I think in the same way, like the blood test that you're supposed to be able to take one prick of blood and analyze every disease on the planet, you didn't build that, nor did you have any ability to build that, but you maintained the illusion that was going to be the thing you were going to build. It's not that different, I'll be quite frank. And I think the rewind to the Balaji portfolio, Bitcoin and Ethereum, they do stuff. People use them for stuff, right? Like I want to store wealth, I use Bitcoin. I want to like own a piece of this network, or I want to execute a function on a smart contract on a trustless network, I'll use Ethereum. Like these two things, I think, have proven that they sell a product, right? They both sell something, and they have been for up close to a decade. And I think the burden of proof is on whoever is putting shit out into the world to like articulate what their thing does. And as soon as it doesn't do the thing it said it did, like you either intentionally misled people and it never was going to, or you just didn't think through it correctly, right? But to attract that amount of capital and to wreck that many people in the process, it's like all of the digital properties of Terra were like so slick and beautiful that it kind of fools you into thinking like, wow, this is legit. Like this looks like, it's not like some of those DeFi, those farms that Bilal, you've probably been on, like Banana Swap or whatever. You're on there. You're like,
Banana Swap.
I know I'm losing my money on this, right? Absolutely I know not. This is a bunch of
banana coin.
Lads, like, yeah. It's just like the arcade, right? You're at the casino on your computer, that, but you load up Terra, and then that thing is like slick as anything and looks very legit and polished. And he's like, Sam Bankman-Fried said, it's like, a huge amount of memes and marketing, but at the end of the day, it was like just a flawed, the idea was flawed, right? It didn't work in practice. So yeah, I don't know how it's going to go through the court system, but I'm sure people are going to be like, you made a claim, you used the word stablecoin, which you would imagine puts the onus on you to deliver on the promise of value that you made. So I don't know whether they had, I think in that Sailor interview with Raul as well, is like, most of these people never even work with a lawyer. They don't have general counsel. They haven't operated at this scale. Like, if you're going to take that much capital on and not have like any legal framework or guidance, so I'm not saying they didn't have any. I'm just saying, like, you clearly have to, and there's a delicate balance here, right? There's people that use like work within legal frameworks or do things without consulting legal frameworks, and amazing things get built that way. But at the same time, like, it depends on what you're building and why you would choose to step around a legal framework, right? I think if you're trying to rebuild the structure of money, like a Satoshi creation in 2009, it's like you don't need to hire a lawyer to do that because it's like the first of its kind experiment. But if you're bringing a competitor into an ecosystem that already has like 10 or 12 viable options, it's like you would think that you would approach that a little bit differently. I don't know. Fortunately, like I just played around with it a little bit. I lost money, but like from an experiment of just like playing with the interface versus putting a bunch of money in there. And I think we talked about last week, people were buying houses off like the assumption they're getting 20% APY. And it's just, I mean, obviously we talked about this. It's like, it's just not realistic. Like, where is it coming from? I don't think, it's very obvious to see where the money comes from in Bitcoin and Ethereum, I think, versus like a 20% yield for doing nothing.
Yeah. Well, Jack, I was just going to add, I think that was a really great point. I think what you alluded to there was around the idea, like in startup world, you hear this a lot, ask for forgiveness, not permission, right? So one of the Uber guys, one of the early employees goes and creates a bird scooter, and instead of going and figuring out, which for people who don't know is like the scooters around Venice Beach and different cities where you jump on it and they're kind of annoying, but and that was a pretty cool example where they were like, if we need to go to a local council and get permission and find a space, it's going to take 17 years. So instead they ordered that shit from China or wherever it was. They dropped 20 of them, made an app, and then got people to scan a QR code, and that went off. And again, you can argue if that was good or bad or whatever, but that is the sort of stuff that Airbnb, Uber, and others that are now have created something, not just an idea, and followed through. They kind of had to do that. I think there is a line though, right? And when it comes to money, I think especially like we've said 100 times on this podcast, when using the word stablecoin, there's just the burden is, the threshold is just a lot further. There needs to be a higher threshold for that sort of stuff. So I think that's an interesting thing. And then the last thing I was going to say, the quote you mentioned there, which I just looked up because it's a killer quote from The Big Short. He said, "Tell me the difference between stupid and illegal, and I'll have my wife's brother arrested." Amazing.
That's so good, man.
It's such a good line.
Ryan Gosling is so good in that movie.
He's the best.
I mean,
I love that character so much.
Movie
when he
is so
pulls him,
good.
he's at the gym. We'll move it up, man.
Well, actually, since we're talking about, there's been a huge debate online about The Big Short versus Margin Call. Have either of you watched Margin Call yet? The movie? It's on Netflix.
I've like watched it in the background before.
I've seen
it. It's The Big Short.
It's good though. It is very good.
All right, like, I'm gonna have to watch it.
Jeremy Irons is like, because Jeremy Irons is kind of the villain in there, and he's just like, basically just goes in, we're going to dump the steaming hot pile of shit onto the market. Yeah.
We're selling a product people want at a price they're willing to pay for it or something, right? That was
this is fraud. It's like, no, you're selling people a product at a price they're willing to pay. It's like, we'll never do business again in this town. It's like, it doesn't matter. It's like,
all right, I need to watch it, man.
Amazing.
We'll do a reaction.
It's great.
All right, cool. Boys, should we wrap up Terra now? Because I know we've got a couple of things to talk through. Anything else before we talk about that? I hope you guys enjoyed that, because I I think that was a good recap of all the things we missed from last week.
Wait, I have an idea. You know what we should do? We should just do a full episode about margin call. We should all watch it, just have notes, and just like literally walk.
We live stream it and watch it live.
I think we watch it and hit it with the categories. Have people ask us questions, be like, "Who is like the most insane character? Like, what's the funniest scene? Like, when the ringer does it, that'd be fun, man."
I'm up for that.
We should do it.
Well, we already know the best quote.
That is the best. Man. Well, there's a few good ones in that film, man. All right, Jack, that was good chat on the Terra stuff. You wanted to tell us about an NFT project. Are we in NFT winter yet? Or what's the vibe? Because I know we're kind of in a bear market in the crypto world.
I think it was the lowest volume of transactions on OpenSea one day last week. So we're definitely getting quiet out here. But we're still bringing you innovative projects from within the NFT ecosystem.
The edge of the internet vibe.
Yeah, we're going to talk about Lil Nouns. So let's fire this up.
I was saying that sounds like a rapper, man. Lil Nouns.
Yeah. So these guys, we've gone through the Nouns site before, right? So if you look at Nouns, they've essentially cloned the Nouns project. So as we know, Nouns is CCO, open source. Anybody can take any element of this project and use it in whatever way they want to use it. So Nouns, to recap the concept. Yeah, go on. To recap the concepts of Noun, they auction an NFT every day, and they add the proceeds of the NFTs to a treasury. And then the people who own the NFTs vote, there's a governance structure that votes on how to disperse that treasury model. Okay. So the founders of the project actually get paid in Nouns. So they don't take any capital. They get paid in NFTs. Every 10th NFT gets sent to a treasury that they share. And so it just aligns incentives in a different way than a lot of other NFT projects, right? So you have these group of people that aren't looking for like a quick flip, high liquidity project. They get invested, they get in the community, they build stuff, they fund projects. The idea is to grow the Nouns brand over a huge period of time, right? And if you think about competing with like a CryptoPunks or a Bored Apes project, they're only releasing one a day. So it will take them 10 years to get to the supply of 10,000. So it's very, very interesting. And that you see really interesting dynamics happen in the auction because of that, because you only really need a couple of buyers that are enthusiastic on a daily basis, right? And you can maintain some pretty impressive sale prices.
80 ETH bit, so it's 160 grand?
160K, yes. So
that's the original Nouns, right? Because those are really expensive.
Original Nouns, yeah. So they go at the moment 80, 90. There's one for 160 the other day.
And sorry, Jack, just for long time listeners, there's some connection between the Nouns and the cryptos, right?
Yeah. So if you listen to one of our episodes last year, one of the contributing artists, his name's Gremplin. So he's a super talented dude who's like this aesthetic. Some of the elements of the Nouns aesthetic bleeds over into cryptos. They're both CCO projects.
Like the glasses.
Someone else. Yeah, there's actually someone else to talk about on that I'll try and squeeze in as well. But so this project, again, CCO, anybody can use it, fork it, take the artwork, make T-shirts, make a brand, do a movie, whatever you want, right? And the function of the treasury is to spread the Nouns meme. So that capital is people submit proposals, and then everybody who holds an NFT can vote on sending that money in whatever direction they want to send it. So Lil Nouns is a permissionless fork of the Nouns project. And what they've done, you can probably tell here, is like they've taken the same aesthetic, but the idea is they're like kid versions of these NFTs. So they just kind of exaggerated some of the features. So if you look at the difference between these, it's got like these big glasses, little body. And what I think they've done that's really interesting is they send one of these NFTs to the Nouns treasury. Every 10th auction gets sent to the Nouns treasury, which is cool because they're aligning incentives with the original. And the auctions are 15 minutes long. So taking that like timed auction mechanic and obviously compress the time of it And then there's another little nuance in here where the auctions get kicked off manually. So once this auction finishes, someone has to settle the auction. So either whoever bought the previous, like settles the auction and puts the NFT in their wallet, or someone who wants to bid on it comes and settles the auction and it kicks off another 15 minutes. So someone I wrote on Twitter, I haven't done the math on this, but it seems about accurate, is that because this is unlocking a lower price point, they're accruing capital at the same pace as Nouns. But it's obviously a very different buyer, right?
Oh, they're doing 100 a day. They're doing 100 a day, right?
Yeah, well, at this point, yeah, it's only been around for 2 weeks, but it just started kicking up like yesterday or today. So they've been going for, 0.2, 0.3, and now you're seeing most of them go for over 1 Ethereum. And they have plans to acquire a Noun as a DAO. So if they'll use their treasury proceeds, or this is, the discussion that's happening, they'll use some of their treasury proceeds to buy a Noun, and then ownership of any one of these would give you obviously exposure upward into that treasury that holds the Noun. So just an interesting,
Jack, go back to the other one. I love that the top bidder for Little Noun 396 is DeesNuts.eth.
I saw that as well. It's hilarious.
So for the listeners, the top bid for this goofy looking Noun NFT with yellow sunglasses is DeesNuts.eth. Good luck to DeesNuts. Hold on. Let's keep it on the screen. I want to see if DeesNuts wins this auction. It's going to end in 14 seconds. Keep it 13 seconds.
Yeah,
we'll see.
All right.
Countdown.
So sorry, guys.
And while you're pulling that up, I also would, since I always share my screen as well, I can see that Jack was trying to spell necessary, because I can still not spell that word either. In your other tab.
Absolutely horrendous.
DeesNuts is a winner.
Congratulations to DeesNuts.eth.
Yeah, if you're listening, DeesNuts.
Sorry, I did not mean to call out your tabs. No, I do that all the time.
That's good. I was just wondering what else I had up there, but it's all good.
There could have been a lot worse, Jack. Could have
been worse. Yeah. But you know what I think is interesting about this is 4156, who we've talked about a bunch on the podcast, who is like the architect of the Nouns mechanics that on the auction side. Always remember him saying the auction is a more interesting thing than the art. The auction mechanics is more interesting than the art piece as a catalyst for growing a project, because you bring someone on. In the case of Nouns, you bring someone on every day, right? So someone comes in the community, everybody's watching that one auction, and the person joins the Discord, and it's like, hey, we saw you got that thing. You make connections with everybody. You onboard one person at a time. And I think the flywheel effect has a much stronger likelihood of success in an environment like that, right? In contrast to, here's 10,000 of these things. We're going to sell them in 15 minutes. And then hopefully everyone's just going to migrate from wherever they were before and start caring about our stuff. So I think I've said many times on this podcast, I'm an admirer of the Nouns ecosystem and the people and the thinking that's gone into building it. I just think this is an interesting derivative project. And I think this auction mechanic in particular is going to be interesting to see what people start doing with this, and just see what happens with a treasury of this size and how they deploy capital versus, Nouns that have 60 million or whatever in their treasury.
The treasury's actually gone up for Little Nouns by 2 ETH since we started this call.
Yeah, DeesNuts just bumped it up.
DeesNuts dropped it in there.
Yeah.
Gave it a little dip. Nice one, Jack. Thanks for sharing that, mate.
Yeah.
That's
I know
great.
you're involved.
You.
Are you in the Nouns DAO?
Yeah.
Was that?
Yeah, I am. Yeah. And let me do a little shameless plug as well. I got I'm doing a
Bag Pump of the Week Part 2.
Yeah, this is a new segment.
I'm forking my CCO and Noun stuff into an account of its own. So Noun 141. I'm just posting that out separately.
Amazing.
If anyone wants to listen to that.
Love it. That's sick. Love it, mate. Thanks for sharing that. We're all edge of the internet. Well, I will say this is definitely not investment advice, but you know what they say about making fortunes in downtime. So, I mean, this is often the time where things are on sale if you believe in them long term, like the S&P 500 or a noun, depending on what your flavor of the week is. So check it out if you're interested. I would definitely check that out as well. Trung, let's wrap it up, mate. We got another 10 minutes to blast through this last segment. We got Fun Fact Fan. McDonald's to leave Russia for good after 30 years. But you've got a wider lens to talk about McDonald's. So
we don't.
Over to you, mate.
Obviously, still such a terrible conflict going on with Russia's invasion of Ukraine. This is kind of one of the last corporate America shoes to drop. So McDonald's famously arrived in Moscow, January 31st, 1990. A lot of people have probably seen this image, but the first day the lineup was huge. Around the corner, there's photos from NPR. Crazy, man. I'm thinking about waiting that long for some Maccas. So that was 32 years ago, people. 32 years ago. Well, actually,
did you call it Maccas? Is that what you just called it?
That's how the Aussies call it.
Yeah,
funny enough, actually, the Wendy's Twitter account actually responded to your boy earlier this week. That was pretty funny. I don't know if you guys saw that, but
no, what they say?
So somebody posted a fake job posting for a Wendy's job. I think it was in Illinois. And the first requirement was, if you've recently been involved in the Terra UST project and you're looking for a job, we have an opening for manager or something. And it looked real. So I just straight up asked them, like, Wendy's, is this real? They're like, no, it's not. But we could use people with crypto experience. And they just winked. But
man, there's been some brands really owning it. I will say in the last week,
Ryanair, dude. Oh, my God.
Were killing the game. Is that all of those real? There's
the Ryanair
ones.
ones are real. They don't give an F. But we'll go through the McDonald's NPR just super quickly. Obviously, this was kind of already happening. They kind of ceased operations, let their local partners in Russia continue running the restaurants. The restaurant makes like $1 billion a year. The restaurants in Russia make $1 billion a year. So not super material, 2 to 3% of their entire business. They have tens of thousands of employees in Russia, 62,000. They plan to keep paying them until they can sell to a local partner. And there's a term that they're using. They said that they're de-arching the McDonald's in Russia right now. So they're removing the arches. So that's what's happening. 32 years they've been in Moscow. It was a really iconic moment when McDonald's went to Moscow because this will segue into the next segment where we're going to talk about McDonald's as a real estate company because we've teased talking about it before, but we can run through it today. But when they signed the lease in downtown Moscow, the agreement they got with the city and was 49-year lease, a 1 ruble rent a year. So that was their agreement to bring McDonald's into the country. They were like, "Hey, we'll do it, but here's how we're going to do it."
Wait, did you say what year was this? Sorry,
the 1 ruble a year rent is ceremonial, right? The 1990 agreement that McDonald's had with Moscow. So today, this is what McDonald's has. They have $42 billion worth of real estate, and then 35% of their $20 billion in revenue. So a third of their $20 billion in revenue is rental income. How crazy is that? Like we joke around here, it's like, oh, Starbucks is a bank, and like, Harvard is really a hedge fund that's as a school that has a school attached. Like the McDonald's real estate meme is just so funny. It's just absolutely hysterical. But so I'll walk through the numbers because it's fascinating and a little super brief history. 39,000 McDonald's around 100 countries in the world. Here's the kicker. They own Jack just messaged
said in the chat.
Chips to bricks, literally chips to bricks.
That's so good.
Well, actually, what's funny about the chips to bricks is McDonald's had this whole real estate thing from the very, very beginning. Like they had it from the 50s. I mean, I'll kick it back to you guys. Let's make this a little bit more conversational. What do you guys know about McDonald's as a real estate company? Like, what is your understanding of it right now?
Well, watch Founder. That's a great film, man. That's
yeah.
And I read I can't remember what it's called, Golden Arches or something. But
okay, so what top of mind? Yeah, totally top of mind, right? Ray Kroc, the milkshake salesman who teamed up with the McDonald's brothers and ended up scooping it from them, right? You're right. totally. I mean, that's the other part of it. There's a human side, ruthless, absolutely ruthless. So back to their ownership today, they own 55% of the land under these 39,000 stores. It's absolutely insane. It's just insane.
Crazy.
And they own 80% of the buildings. So the real estate model actually wasn't Ray Kroc. It was from Harry Sonnenborn. You will remember. You know who he was in the movie? BJ Novak.
It was
from BJ Novak from The Office. So Harry Sonnenborn came up with the real estate model. So I mean, I think Jack will appreciate this because he appreciates it. He appreciates a franchise, right? So this is why they pivoted into real estate. It was from the movie, but I found this point super interesting. So most franchisee models is you pay the franchisor, so McDonald's, you pay them an initiation fee. In the case of McDonald's, I think it's like 50 to 100 grand. And then they start kicking up the royalty payments, right? You got to kick back 2 to 3% of sales a year to them. And then they sell you supplies. So they'll sell you potatoes, and you bet your ass are marking those potatoes
Just
up.
sounds like the Step-In app all over again, bro. What's good? So I pay for the app, then I do the work, and then I have to pay for more stuff. That's basically what I realized.
Welcome to the layer cake, son.
No, but Bilal, you nailed it though. So if you're the franchisee, you're the company building up these out, and you got the rights. You're like, wait a second, you guys are gonna keep squeezing this juice out of me. So this is in the mid 50s. This is where Harry Sonnenborn, Ray Kroc's partner, this is where he switched the model to real estate. This is why, because all these franchisees were like Bilal. They're like, guys, slow down here. I don't want to deal with these royalty payments.
But they were degenerates? Is that what it was?
So Sonnenborn goes, okay, if you're not going to pay with the royalty payments or you don't want to pay them, I want to do a little twist. I want to own that real estate. You're going to be my tenant. I'm the landlord. But as part of the tenancy agreement, you have to do what I say as a McDonald's franchisee, or I'm going to kick you out of the location. So it's actually genius from a business perspective. It's really messed up, though, for the franchisees, right? Because think about that. Bilal's complaint now has gone out the window. Oh, you don't like the
100%.
royalty payment? Cool. You don't have to be here anymore. Yeah, you're no longer the tenant.
So, Trung, you might have said this right in the beginning, but just remind me, what percentage of their money is made through the real estate part then?
So the rental income, which we're talking about now, is 35% of the revenue.
That's mad.
It's 6 billion plus of their 20 billion. I think that's from either 2020, 21, but ballpark. So they create the McDonald's Franchisees Real Estate Corp, and they just start squeezing fools. They buy real estate.
What do you think their gross margin is, Trung?
On that, I have the numbers here. I'll pull it for you. So
CFA
this is the line
coming out.
Yeah, exactly, right? Well, before I answer Jack's question, I'll tell you what Sonnenborn told his Wall Street buddies. He goes, "We're not in the food business. We're in the real estate business. The only reason we sell 15-cent hamburgers is because they are the greatest producer of revenue from which our tenants can pay us rent." Bro,
yeah, man.
Dude, that is like 15-cent burgers, inflation, son. Like, kick rocks. All right, so, well, I'll show some visuals here, actually. Actually, we don't have to show the visuals, but the numbers that you asked for, Jack. So, man, they only, the franchise revenue is 11 billion. Only 4 billion comes from the franchisees fee. The other 6-7 we talked about is from the rents. Dude, if you're asking margins on that, what do you think the margin on that is? It's the front office, right? It's the front office. Like, it is just automatic at this point.
Are there any other buckets of money there? Sorry, rent, franchise fees, and is there anything else?
Yep, I'll show you guys now. This answers Jack's question exactly.
I'm actually curious, yeah.
Yeah, here we go, people. Here's a CFA fan. Look at this table.
Oh, this is a real one. This wasn't a joke, because sometimes you put fake numbers in there as a joke.
No. wait, Bilal, can you read that out here? Can you talk about? Okay, so they own some restaurants. I'll talk it out. Sorry, so I'll make it very simple. So they also own restaurants. They own 15% of the entire restaurant selection that they have. The other 85-ish are franchisees. So the ones that they own, they actually make a lot of money on them. They're probably primo locations. But to Jack's point, they have operating expenses. So their operating margin on company-owned McDonald's is 14%. And
this is filth.
Yeah.
This is filth.
And here comes
wait for the
Jack,
punchline. Here we
yeah,
go.
and here comes Jack Butcher. And this is why on the Non-Investment Advice podcast, we always joke that Jack Butcher likes a franchise. The McDonald's operating margin on its franchise-owned businesses, so this is the ones that they rent out the real estate, but the franchisees run it. It's 80%. It's 80%.
So they don't have to be on that, haven't they?
Yeah, that's Google it. That's like Google search. Bilal, that is like Google search.
Yeah, it might even be better. Yeah, if you took Apple and all those other guys taking a cut.
So the number, I'll finish off the number one. Bilal, to your point, what the split was, it's 7% are company owned. So it's crazy. Half their revenue comes from company owned. These must be like the New York Times locations or like, New York Times Square, like the big ones, right? But obviously, if you're operating it, yeah, it's costing a lot of money to operate. But franchise owned is 90%. I'll walk through a couple of things here. You guys will enjoy this, especially for we talked about fast food DAO that we're gonna do, but turns out we can't do it.
Good thing we didn't, mate. We'll be
exactly. Right now. Do it. Shit.
So
Jesus,
this is
Domino's DAO.
Well, let me ask you guys. You guys will probably know a couple of these just from common sense. What do you think McDonald's is looking for when they're buying real estate? Like, what are the exact things that they're looking for?
I remember, this might be anecdotal from somewhere, but they want it like on intersections. So it's like you want traffic coming from as many directions as possible. I don't know how true this is, but near like places where kids are gonna make their parents pull over. So it's like on school routes and stuff where it'll be like kids in the back of the car, like, let's go to McDonald's. Maybe retail, near other retail stuff.
Like a mall. Yeah.
Yeah.
I actually didn't know with a kid one. I fully buy that.
I think Jack passed the test. I would just say that was impressive.
That was really good, man.
I was gonna say late night
franchise, boys.
You love a McDonald's at 3 a.m. too, I'm sure. So,
yeah, exactly right. So I'll throw to the last 2 points. Jack's nailed it on the head there. So they are looking for corner wraps with signage on 2 major streets. Totally makes sense. This is the other kicker. They want lights. They want traffic lights. So MF stop. Smart. They want 23-foot build height, potentially for the drive-through, or 2 floors, 50,000 square foot.
So are you laughing at him saying MF stop as well? Is that what you
yeah.
MF stop? I had to think for a second what that meant, and I was like, oh, the word I use 72 times a day. All right.
Yeah.
So here's let me give the last note then, and we can wrap it up. But something very smart about what McDonald's does. It's a bit of a financial engineering itself. So they buy these real estate properties. So they own $40 billion worth of real estate around the world. Those financing for real estate is fixed, right? It's 4%. So they're paying 4% to finance these properties and then ultimately own it. Guess what? Inflation, they get to bump up, and their franchisees get to bump up prices. So their expenses are fixed, but their revenue, which is a percentage of the franchisees from the royalties, is indexed to inflation. So it's an extremely, extremely smart way to keep getting, inflation pegged money while they pay fixed rate. So it's actually genius, absolutely genius.
Boys, can I do I'm just going to do it.
Go. Ask for forgiveness, not permission. Here we go.
So we're going to do a second meme of the week. This is, for anyone not watching, this is the scene from Wolf of Wall Street where Leo DiCaprio is like proposing Stratton Oakmont, and the caption is, a stable coin backed by a Costco hot dog and Pepsi. I was trying to get a couple people tagged me in this week because of the obvious love that we've shown for Costco over the episodes here. But just listening to you talk about that, Trung, I was like, man, these guys, the value has been established, so they just keep collecting rent. It's very what an insane business. And I think in times like this,
increasing inflation, right, is nuts. They get to keep the franchisees keep pushing the price. Like, as you said, it's fixed what they're paying.
Yeah, it's nuts.
Jack, you still got that Costco hat that you shared in the Telegram group?
Oh yeah, I got it downstairs. I wear it next week. Yeah, my wonderful wife Celia procured that for me.
Thank you, Celia.
Thank you, Celia.
Little eBay action. All right, boys. I think we're hitting time. Thanks for that, Trung. Great wrap up there on McDonald's. Let us know what you thought of that in the comments. Anything else on McDonald's before we wrap that up, boys?
That's it, man.
No, that was great. Thanks, Trung, for dropping knowledge.
Yeah, that was great, man.
Absolutely.
And we're just at time as well. Perfect timing. Hope you guys enjoyed that one. And we've got a lot more coming. There's a couple things we had on our docket to potentially talk about this week, which we'll talk about next week. So the 6529 bear market investor psychology stuff, I'll talk through a few of those things. And then there was a longer discussion on Vitalik's thread on contradictions that, again, we can talk about anytime. There were some really cool ideas in there that I think we can bring to next week instead of this week, because we hit time today. But anyway, thanks for your support. Thanks for making us number 32 or whatever it was on the investing charts.
Yeah,
and if you are only listening on YouTube or Spotify, just open up your phone and open up the Apple Podcast app and press subscribe and hit a review if you can. You don't have to write much, but it always helps push us up. And let's make this meme a reality and put us number one investing in the charts. That would be
incredible.
We'll do something special for that.
Screenshot. Yeah.
It's going to take
a time. I'm sure it'll take a little time, worthy, boys. That would be
NFT. That might be worth the first ever NIA NFT if we do it.
If our listeners, our incredible listeners, push the not investment advice to the number one spot in the investing category of the Apple Podcast, it'd be unbelievable.
Just to put in perspective, we were above Naval this week, and we were one below. What was it?
Invest like the best, which is honestly one of probably the best investing podcasts.
I think they're really good. And then in the business category, we were above Goldman Sachs. Was a really happy moment for me. I pitched them once upon a time for my little business and didn't make it. But
and you know what? They give investing advice, which is the opposite of what we do.
Exactly. We do not do that. All vibes, no facts. Come for the alpha, stay for the vibes. That's the new one as well. Anyway, thanks again for your support, everyone. And we will see you next week. Hit the like button on YouTube as well if you're still here. That would be very helpful. And we will see you on the next one. Cheers.